On the morning of July the 31st, 1914, the New York Stock Exchange did not open. That had never happened before. Not once in the exchange's history. The governors simply voted to shut the doors indefinitely. The reason had almost nothing to do with America. It had everything to do with London. Panicked British investors, desperate for cash to finance a war that had not even officially started yet, were dumping American stocks and bonds, roughly $3 billion worth of them, and converting the proceeds into gold to ship back across the Atlantic. Most people assumed that American financial dominance was inevitable, that the United States was always destined to become the wealthiest, most powerful economy on Earth. But here's the thing. In the summer of 1914, the United States was not the center of the financial universe. It was a satellite orbiting London. Now, I'm not here to tell you that the two world wars did not matter to this story. Of course they mattered, enormously. But the version most of us were taught, that America simply grew bigger and richer over the 20th century and the crown naturally slid from London to New York, is dangerously incomplete. Because the true story of how the United States replaced Britain as the financial capital of the world was never really about tanks or battleships or who technically won which war. It was about credit. It was about gold sitting in vaults. It was about who got to decide on any given morning what a piece of paper stamped with a number was actually worth. Follow the money on this one, and the story gets far stranger and far more deliberate than the one you learned in school. So let's go back. Not to 1929 and not even to 1914. Let's go back to the world before the First World War, when an office in the City of London, not a boardroom on Wall Street, ran the planet's money. Here is the critical thing that most textbooks gloss over about the early 20th century. In 1913, the British Empire did not just control roughly a quarter of the Earth's land and population. It controlled the Earth's money supply, in the sense that mattered most, which was credit. By the end of that year, British investors held something like £4 billion in overseas assets, railways in Argentina, gold mines in South Africa, government bonds in Japan, plantations in India, a sum equal to almost a third of the entire nation's wealth and roughly twice its annual national income. No country before or since had ever committed that share of its savings abroad. Roughly half of all new capital raised anywhere in the world in a given year was raised in London. The Bank of England, founded back in 1694, was not merely Britain's central bank. It was, for all practical purposes, the world's central bank. Sterling was not just Britain's currency. It was the currency every serious international transaction was priced in, insured in, and settled in. Practically speaking, this meant that if a cotton merchant in Alexandria wanted to sell his crop to a textile mill in Bombay, the transaction was very likely financed through a London merchant bank, denominated in sterling, and cleared through machinery the Bank of England ultimately stood behind, even though neither the buyer nor the seller had ever set foot in England. Firms like Baring Brothers and N.M. Rothschild and Sons had spent a century building exactly this kind of invisible infrastructure, which is a large part of why historians still describe the City of London of that era as something close to the world's clearinghouse. Now, contrast that with the United States. Here is something that might genuinely surprise you. In 1913, the United States, soon to become the largest economy on the planet, did not have a central bank at all. It had not had one in any permanent sense since Andrew Jackson killed the Second Bank of the United States back in the 1830s. What it had instead was a patchwork of thousands of independent banks, no coordinated lender of last resort, and a currency supply that contracted every autumn when farmers needed cash to move the harvest and expanded again once the crops were sold. This was not a minor inconvenience. It produced a financial panic roughly once a decade, like clockwork. The worst of these, the Panic of 1907, got so severe that the United States Treasury had no institutional mechanism to stop it. So a 70-year-old private banker did the job instead. J.P. Morgan personally summoned the presidents of New York's trust companies to his private library on Madison Avenue and, according to several accounts of that night, effectively refused to let them leave until they agreed to pledge $25 million toward a rescue fund. Make of that what you will. A single financier, operating out of his own house, was the closest thing America had to a central bank. And here is where the story gets genuinely interesting, because the men who wrote the Federal Reserve Act in 1913 were not only trying to prevent the next panic of 1907, they were also, quite explicitly, jealous of London. Under the old national banking system, American banks were legally barred from accepting bills of exchange, the short-term financial instruments that greased the wheels of international trade. That meant even when American companies bought and sold goods with each other across an ocean, the financing for that trade routinely had to be arranged through a London merchant bank, in sterling, on London's terms. American commerce, in other words, was paying a toll to a foreign financial system just to do business with itself. The architects of the Federal Reserve wanted a dollar acceptance market that could someday rival London's. They got their wish far sooner, and in a far darker way, than any of them expected. Because a little over a year after the Federal Reserve opened its doors, the war that emptied the New York Stock Exchange arrived. And once the shooting started in earnest, Great Britain discovered a problem that £4 billion of overseas assets could not immediately solve. War does not run on railway bonds in Argentina. It runs on cash, right now, to buy shells, wheat, and rifles from whoever will sell them. And the country with the industrial capacity to sell enormous quantities of all three, sitting safely across an ocean from the trenches, was the United States. The financial takeover did not happen in isolation either. As Britain diverted every spare pound and every spare ship toward the war effort, it was forced to pull back from markets it had dominated for a century. American exports to Latin America alone surged by more than 75% in 1916, filling a gap British merchants simply no longer had the capacity to fill. Even Japan managed to grab a slice of markets Britain had long treated as its own, expanding textile exports into India, China, and eventually into Britain's own domestic market. The war was not just draining Britain's gold, it was handing away its customers. So Britain and France did the only thing they could. They came to Wall Street and asked to borrow money from the very financial system their own bankers had spent a century treating as a junior partner. In the autumn of 1915, a delegation led by the British diplomat Lord Reading arrived in New York and negotiated what was, at the time, the largest foreign loan in Wall Street's history, $500 million, arranged through a syndicate led by J.P. Morgan and Company, now run by Jack Morgan, following his father's death 2 years earlier. Morgan's firm did not just lend the Allies money, it became their official purchasing agent in the United States, placing more than $3 billion in contracts with American factories, farms, and shipyards over the course of the war. Think about what that arrangement actually meant. One private New York bank was simultaneously deciding which American companies got rich supplying the war and which European governments got the credit to keep fighting it. By the spring of 1917, the overdraft the Allies had run up with Morgan's firm alone reached nearly $400 million, an amount so large that when President Woodrow Wilson, still clinging to official neutrality, ordered the Federal Reserve in late 1916 to discourage American banks from further foreign lending, it very nearly broke the entire Allied war effort before the United States had fired a single shot. Then, in April of 1917, America entered the war directly, and the financing shifted from private bankers to the United States Treasury itself. Treasury Secretary William McAdoo, the same man who had shut down the stock exchange less than 3 years earlier, began extending government-to-government loans directly to Britain, France, and the other Allied powers, tens of millions of dollars at a time, dispersed in installments as the fighting demanded. By the time the guns fell silent in November of 1918, the numbers told a story that no general or diplomat could talk around. Britain's national debt, which had stood at roughly £650 million before the war, around 30% of its economic output, had exploded to nearly £7.7 billion by 1919. That is not growth. That is a nation that spent 4 years converting itself from the world's largest creditor into a debtor almost overnight, mostly to Washington and to Wall Street. The United States, meanwhile, had gone from a nation that owed money to Europe to a nation Europe owed money to, on a scale nobody had planned for and nobody quite knew how to manage. The historian Adam Tooze, whose book on this exact transformation remains one of the definitive accounts, has argued that the First World War did not so much cause America's financial rise as violently accelerate a shift that was already quietly underway, and that the men running the war in London and Paris were catastrophically slow to grasp just how completely the ground had shifted beneath them. Now, you would think that a Britain buried under nearly £8 billion of new debt would have been eager to adjust to its new, more modest place in the world. Instead, the men running British monetary policy in the 1920s did something almost willfully stubborn. They tried to pretend the war had never happened, at least where the pound was concerned. Here is where we encounter one of the strangest decisions in modern financial history. Sterling had traded as low as $3.38 in February of 1920, a realistic reflection of Britain's weakened post-war economy. But Montague Norman, the governor of the Bank of England, believed with almost religious conviction that restoring sterling's old pre-war exchange rate of roughly $4.86 was essential to preserving London's status as a financial capital. Winston Churchill, then Chancellor of the Exchequer, privately had doubts. By his own later admission, he understood almost nothing about the technical arguments involved, and he once complained that when economists explained it to him, they might as well have been speaking a foreign language. But he trusted Norman's confidence more than he trusted his own uncertainty. And in April of 1925, Churchill announced that Britain would return to the gold standard at that old pre-war rate. Historians still refer to the maneuver, only half-jokingly, as the Norman conquest of $4.86. John Maynard Keynes thought it was a catastrophe waiting to happen, and he said so immediately, in a pamphlet with a title that left no room for ambiguity, The economic consequences of Mr. Churchill. Keynes's argument was straightforward. Pegging the pound at a rate that overvalued it by as much as 10% would make British exports more expensive on the world market at the exact moment Britain could least afford to lose customers. The only way to compensate would be to force domestic wages and prices down instead. And the only tool available to force that kind of deflation was to make credit expensive and jobs scarce. Keynes was right. British coal exports collapsed almost immediately in the face of cheaper German and Polish competition. Mine owners demanded wage cuts to stay competitive. The miners refused, and in May of 1926, the standoff helped trigger a general strike that shut down the country for 9 days. Churchill himself later called the decision to return to gold at that rate the single biggest financial mistake of his career. And the deeper, more uncomfortable truth underneath the whole episode was this. Britain was trying to run 1913's monetary policy on 1925's balance sheet. Because admitting the balance sheet had changed meant admitting that London was no longer the only capital that mattered. And the gold standard fiasco was not the only place London's old habits ran headlong into a new financial reality. In 1924, with Germany's currency in ruins and its economy paralyzed by the French occupation of the Ruhr industrial region, the victorious powers turned to an American banker named Charles Dawes to design a rescue plan. The Dawes Plan, as it became known, arranged for Germany to receive roughly $200 million in gold, raised overwhelmingly on Wall Street rather than in the city, to stabilize its currency and restart its economy. And here's the thing that most history books gloss over. This created a bizarre circular flow of money. American banks lent dollars to Germany. Germany used those dollars to pay reparations to Britain and France. Britain and France then turned around and used a share of those same reparations to repay their own war debts, owed, of course, to the United States Treasury. Money left New York, traveled to Berlin, traveled to London and Paris, and then traveled straight back to Washington, completing a loop that generated fees for American banks at nearly every stop along the way. It was, in effect, America financing Europe's ability to pay America back. The arrangement worked beautifully right up until October of 1929, when the same Wall Street that had been so generously lending to Berlin suddenly had far more urgent uses for its cash at home. And the entire circular structure collapsed within a matter of months. Meanwhile, quietly and without any comparable drama, the plumbing of world finance kept rerouting itself through New York. American banks, now legally able to issue dollar acceptances thanks to the Federal Reserve Act, began financing trade that had once automatically flowed through London. Benjamin Strong, the president of the Federal Reserve Bank of New York, coordinated closely with Norman throughout the decade, and for a while the two men, more or less, ran the industrialized world's monetary policy between them through personal correspondence and transatlantic visits, an arrangement that worked precisely as long as both of their economies could bear it. Strong died in 1928. Britain's overvalued pound could not survive the shock of the Great Depression that followed a year later, and in September of 1931, after a wave of European bank failures triggered a run on sterling that the Bank of England no longer had the reserves to fight off, Britain abandoned the gold standard altogether. The empire that had once dictated the price of gold to the entire planet could no longer even defend its own currency. And then, barely a decade later, the whole cycle repeated itself, only bigger, faster, and with far less ambiguity about who was in charge by the end of it. By 1944, Britain had once again borrowed itself into a corner financing a war against Germany, this time relying heavily on American assistance through the Lend-Lease program. And so, in July of that year, while Allied soldiers were still fighting their way across France, 730 delegates from 44 Allied nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire, to decide what the post-war monetary system would actually look like. On paper, it was a negotiation. In practice, the outcome was close to predetermined the moment the delegates walked in the door, because of one simple fact. The United States held somewhere around 2/3 of the entire world's monetary gold. Britain's delegation was led by John Maynard Keynes himself, by then one of the most respected economists alive, who arrived with an ambitious plan for a neutral global reserve currency called Bancor, administered jointly by all member nations. The American delegation was led by a Treasury official named Harry Dexter White, who arrived with a much simpler plan. The dollar, pegged to gold at $35 an ounce, would become the world's reserve currency, and every other currency would be pegged to the dollar. Keynes fought for weeks. In the end, it barely mattered how eloquently he argued. You cannot negotiate parity with a country holding 2/3 of the world's gold and most of its remaining industrial capacity. The Bretton Woods system that emerged, presided over on the American side by Treasury Secretary Henry Morgenthau Jr., formally installed the dollar, not the pound, as the axis the rest of the world's money would spin around. You might think that after Bretton Woods, the matter was settled once and for all. It was not. Not quite yet, because Britain needed one more American check before the picture became completely clear. The war left Britain's finances in ruins. So, in July of 1946, the United States agreed to lend Britain $3,750 million, negotiated on the British side by an ailing John Maynard Keynes in nearly the last major act of his life. The loan came at a favorable 2% interest rate, but it came with a condition that would prove almost impossible to survive. Within a year, Britain was required to make the pound freely convertible into dollars again. When that convertibility clause took effect in the summer of 1947, foreign holders of sterling rushed to cash it in, and within roughly a month, nearly $1 billion drained out of Britain's reserves. The British government had no choice but to suspend convertibility barely 6 weeks after agreeing to it, a very public admission that the pound could not yet stand on its own in a world that now ran on dollars. 2 years later, in 1949, sterling was formally devalued from $4.03 to $2.80, a drop of roughly 30%, just to keep British exports competitive. Britain had won the war. It could no longer on its own defend the value of its own currency for more than a matter of weeks. By the mid-1950s, everyone paying close attention could see which way the ledger was tilting. You had a British Empire rapidly shedding colonies it could no longer afford to administer. You had a pound sterling that had already needed rescuing twice since the war ended. You had a Bretton Woods system explicitly built around the dollar, not the pound, as its anchor. And you had an American Treasury that had shown, across 4 decades, a growing willingness to use financial leverage as a tool of foreign policy. All that was missing was a moment dramatic enough to make the shift undeniable to the ordinary person watching the news. Nasser gave the world exactly that moment in the summer of 1956. Now comes the part of the story that gets genuinely uncomfortable, because it is the moment the theory got tested against reality one final time, in public, in front of the entire world. And Britain lost in a way that left no room for polite ambiguity about who was actually in charge. In the summer of 1956, Egyptian President Gamal Abdel Nasser nationalized the Suez Canal, the artery through which most of Britain's oil and a huge share of its trade with Asia physically passed. Britain, France, and Israel secretly coordinated a military response, and in October, their forces invaded, and from a purely military standpoint, won almost immediately. This should have been the empire reasserting itself the old-fashioned way, with soldiers and ships. Instead, it became the clearest demonstration in modern history that soldiers and ships were no longer the instruments that decided outcomes like this one. President Dwight Eisenhower was furious that Britain had acted without consulting Washington, and he did not respond with troops or even really with diplomacy. He responded with a balance sheet. The United States blocked a British request for $561 million in standby credit from the International Monetary Fund. It blocked a separate $600 million line of credit from the Export-Import Bank. And, most devastatingly of all, American officials let it be known that Washington was prepared to start selling off its own holdings of British government bonds on the open market, a move that would have triggered a collapse in the value of the pound sterling at the exact moment Britain's currency reserves were already being drained by a speculative run. Britain's Chancellor of the Exchequer, Harold Macmillan, and the Bank of England's governor tried to put on a brave face publicly, but privately, the math was simple and brutal. Within days, Prime Minister Anthony Eden ordered a ceasefire, and by the end of the year, a full withdrawal. Not because British soldiers had lost, because the British pound had. Let me say that again because it matters. A nuclear-armed permanent member of the United Nations Security Council, with troops actively occupying its military objective, was forced into a humiliating retreat, not by an opposing army, but by the threat of a bond sale. It was one of the clearest demonstrations in modern history that financial leverage alone, without a single additional shot fired, could bring a great power to its knees on the world stage. The following January, Eisenhower announced what became known as the Eisenhower Doctrine, formally committing the United States to underwrite Western interests across the Middle East, a role Britain had held and had just conclusively lost less than 3 months earlier. There was one more twist still to come. By 1971, the United States itself could no longer credibly promise to redeem every dollar held abroad for gold at $35 an ounce, largely because decades of running the world's reserve currency had drained a significant share of its own reserves. In August of that year, President Richard Nixon simply suspended the dollar's convertibility into gold altogether, an event historians now call the Nixon shock. You might expect that severing the dollar from gold entirely would have weakened its grip on the world. Instead, the opposite happened. Freed from the discipline of a fixed gold price, the dollar remained the currency every central bank still needed to hold, still needed to trade in, and still needed to borrow in, purely on the strength of institutional momentum built up over the previous half-century. London had needed gold reserves and a functioning empire to back sterling's dominance. By the 1970s, the dollar did not need either one anymore. The economist Barry Eichengreen, in his History of the Dollar's Global Dominance, has made the case that once a currency becomes the one everyone else prices their trade and holds their reserves in, that dominance becomes extraordinarily hard to dislodge, almost regardless of how the issuing country's own finances are actually behaving, a phenomenon he and others have called America's exorbitant privilege. And that privilege, born out of a stock exchange closure in 1914 and cemented in a New Hampshire hotel in 1944, is still very much running today. The dollar sits on one side of nearly 90% of all foreign exchange transactions worldwide, and central banks still hold close to 60% of their reserves in dollars, far ahead of the euro, the yuan, or the pound. And there is a strange final twist to this story that would be incomplete without mentioning it. London never actually disappeared as a financial center. Instead, starting in the late 1950s, it reinvented itself as the trading hub for something called the euro-dollar market, meaning dollars, held and lent outside the United States, largely out of London. The city that once ran the world on sterling spent the second half of the 20th century making its living servicing someone else's currency. Even Britain's financial afterlife runs on American money. And here's the uncomfortable part for anyone tempted to feel smug about the American side of this story. The nation currently sitting at the center of world finance is carrying a national debt approaching $40 trillion, a figure that would have seemed unimaginable even to the architects of Bretton Woods. The parallels to Britain's own overstretched position after 2 world wars are not exact, but they are not nothing either. Empires that finance their global reach with borrowed money eventually get a bill. Britain's arrived in 1956, delivered by its closest ally. There is no shortage of people today predicting that the dollar-based system is due for its own Suez moment, whether from a rising China, a fractured Western alliance, or simply the sheer weight of an ever-expanding pile of debt. Whether any of that comes to pass is a genuinely open question, and serious economists disagree sharply about the timeline, if not the eventual destination. Whoever eventually presents America's bill is unlikely to announce themselves in advance. The next time someone tells you that America simply became the world's richest, most powerful economy because it was bigger or freer or worked harder than everyone else, remember this. It became the center of world finance because 2 wars forced the entire planet's gold and credit to migrate across an ocean. Because a handful of men in private libraries and hotel conference rooms made decisions that most of their own citizens never heard about. And because in the one moment a great empire tried to test whether soldiers still mattered more than balance sheets, the balance sheet won without firing a shot. This is not a conspiracy theory. It is documented history, sitting in Treasury archives and central bank records for anyone who wants to go look. The location of the world's financial capital was never really decided by ballots or bombs or even by boardrooms. It was decided again and again by who was holding the gold and who was holding the debt when the music stopped. If this breakdown of how power actually moves changed the way you think about the 20th century, do me a favor and hit that subscribe button. Drop a like if you made it this far. And leave a comment telling me which part of this story surprised you the most, the stock exchange closing in 1914, the Norman conquest of the pound, or the bond threat that ended the Suez Crisis. I read every single one. I'll see you in the next one.